Hey there, how's it going today? I'm doing pretty good, thanks. I'm Jason Walker, and want to share with you a story that attributes to there's more to negotiate than the purchase price. In this video series, of course, we go through different scenarios and kind of engage you and kind of teach you about what different elements of an offer or contract mean to a buyer and seller in real estate. Uh, I just got out of a meeting with the seller, and I thought this was super cool to capture while I was still in the moment, because these sellers are super intelligent. Uh, this is like their fifth or sixth sale of a home in their lifetime. And so they've seen a few things, and in multiple states. They've gone across state lines in different areas of the United States and bought and sold real estate. So anyway, I wanted to share this with you because it was a, a really interesting conversation. Um, to kind of shape this all up, the offering amount on the home from the buyers was full price. It's a co-op sale. There's another real estate agent involved. Um, we don't know the buyers. They, they're not asking for anything out of the ordinary to be included in the purchase price. Just leave the appliances and take all of your personal belongings and move out. Um, so anyway, that was kind of the rundown of that real quick. What was not so ordinary is, per the seller's request, there's a deferred closing date here. And we're looking at, let's see here, we're looking at a 75-day close, basically. And that adds a different element to the conversation, especially when it comes to the mortgage for the buyer and the mortgage lender and interest rate locks and what that all means for the buyer side of the table. And so anyway, here's how this conversation went. Uh, the a buyer, and we're specifically going to target earnest money. That's the topic today. What earnest money means in a contract and how to leverage that benefits both the buyer and seller. Okay. Um, so anyway, the initial agreement or the initial offer from the buyer was, we'll just call it $500. Okay. It's not very painful. Uh, Anybody that's looking at buying or selling real estate should at least have $500 cash available at any given point in time. Um, So anyway, it was a nominal amount of earnest money in the initial offer. Um, Now, where that led was a few different conversations. We had a letter of credit from the bank, and the in there it described what the offering amount was. The lender was comfortable with all that. We're doing conventional financing. Here's the down payment perceived to be brought to the table the day of closing by the buyers from the lender. Here's the interest rate that we're talking about, and so on and so forth. It was a very well constructed letter of credit from the lender. Now, in our Wyoming state offers, it discloses in there for the buyer interest rates not to exceed X amount of percent. There's a cap. Principal and interest not to exceed X amount. And where that kind of took us was, lenders don't always get good options. Like this, and it all depends on the goal setting with the buyer and seller, right? Or with the buyer. Um, there's 30-day rate locks. There's 45-day rate locks. There's 60-day late locks. The list kind of goes on, and the mortgage lender has to balance with the buyer, right? Like, if we do a 60-day rate lock, here's what it's going to cost you as far as your closing costs go to get this mortgage. If you do a 45-day rate lock, this is what it's going to cost you. If you do a 30-day rate lock, this is what it's going to cost you. And the conversation just, it goes round and round until the day they lock the rate. And like I mentioned earlier, we're at a 75-day out from closing, all of which the buyer was totally comfortable with, by the way. And but anyway, we all kind of sit there, like if we accept this whole deal, we're all kind of in limbo, right? Until the buyer tells the lender, today's the day, we're locking that rate. Whatever the interest rate market is that particular day, today is the day. And if it goes above that cap, uh, the buyer technically can void the contract and get the earnest money back and walk away from the deal unscathed. And really, it puts quite a little pressure on the seller, and one of which you should have a conversation about, with a listing, like myself, a listing agent, and yourselves as sellers, what that means to you and what the risk is. And so that was one element of the conversation. Uh, the other element was the amount itself. And we'll come back to that here in a second. Uh, but then there was, in additional provisions, there was a clause about the appraisal to meet or exceed the purchase price. And to shape this up, in the finance section, the buyer disclosed a healthy down payment, north of 10% of the purchase price. Okay. Uh, yeah, it was well north of 10% of the purchase price. And so the buyer's got some cash, right? And they're committing to this property because they obviously like it. It fits their needs and wants. Like, there's the desirability is there. And so anyway, that was, they got a pretty good margin from their down payment amount versus the initial offer. And then there sits this appraisal contingency. And we know, we've done our homework, we've done the market evaluation, we've run comps, we've done all the work, we've done our homework. We know this price is within market, based on past sales. Okay. And so that was inserted, the buyers inserted that as a protection to themselves, which good job for them. Like, if you're a buyer, you would like that contingency to be in there, especially if you haven't been paying attention to the local real estate market that you're shopping in. That just gives you a blanket of security, right? And two, what happens is it puts the appraiser on notice, saying, hey, I'm a buyer. I wave my hand. I'm a buyer. I'd like to do a deal, but I don't want to overpay. And oh, by the way, my lender's hiring you. So go ahead and tell me if what we've offered is above market value in your opinion. And I'll put emphasis on your opinion, because appraisals are price opinions. So it puts a lot of weight on the appraiser's shoulders. All of which they can handle. I mean, appraisers are super good at running numbers and statistical data and I'm not taking that away from their industry at all. But my point is it adds a level of concern or possibility that, the appraiser's got to kind of weigh in. And it's on paper, because the appraiser gets the contracts after they're commenced on from the lender to go do their job, because there's elements of that contract they need information on to know whether to plug into the appraisal. Does it have an effect on the value or not? So anyway, there was that. And then, of course, we're on back to the 70-day out there in the future to close. When are we actually getting the appraisal? If we was on a 30-day close, we can assume that we're going to get the appraiser to show up to the property within 10 to 14 days, right? Just, that's kind of a soft pitch at the projection. But on a 75-day close, we really don't know when the appraiser is going to come. We don't know when the lender's going to order the appraisal. And lenders control when they pull that trigger, right? So we had that conversation. What's that mean to the sellers? What does it mean to this transaction if we go under contract? So So anyway, we dove into them rabbit holes and discussed them in great detail. And then lastly, the one nobody ever wants to talk about, but from a buyer's point of view, what's the shiny object syndrome? Meaning, hey, if the seller accepts our $500, and then 2 weeks later, because we're on a 75-day close, right? And this would apply to a 3-day close, a 2-day close, a 30-day close, a 6-month close. It doesn't matter. If we're not closing the same day, which really you're not going to get done in the real estate business, there's always the shiny object syndrome. Tomorrow's market's going to be different than today. Meaning, if a better property comes up for sale for that particular buyer tomorrow, it doesn't have to be at a better price. It just has to be within a price range that's tolerable by the buyer. And it could be a property that maybe fits their needs better or their wants better. And they're under contract with us, and they've only risked $500 or $100 or $5. I don't care. It doesn't, the amount doesn't matter. What matters here is, what's the pain point for the buyer not to walk away from the deal when something else shinier shows up in the marketplace? And that's the real question. How do you prevent the buyer getting cold feet and chasing another deal? And everybody's tolerance levels are different. What I can tolerate would be different than you. What you're willing to risk is different than me. The speed of the market, all these things kind of play into this thought process of what is the buyer's pain point. And I think it's something that's overlooked way too many times by those that are unexperienced. And so as a buyer, you want that earnest money to be the least amount possible. As a seller, you need to say, if the buyer walks away from the deal, what's enough money to cover my expenses, or to say, hey, okay, see you, buyer. I'm going to keep your money, and I'm okay with this financial amount that you're going to donate to me, so that I can go back into the real estate market and try again. And I can't speak for other states so much, but in Wyoming, we call it a buyer. It's a buyer beware state, but in the beginning, before closing, it's buyer friendly. After closing, it's seller friendly. So while we're under contract, as a seller, it is not seller friendly. Like the contract laws here for real estate are different. To the degree they're built to benefit the buyer more than the seller. So how do you prevent the shiny object syndrome? And one of the levers to pull here is the earnest money amount, and if it's non-refundable or not. Like, so we have the amount of earnest money, and then is it non-refundable at some point, or are all these contingencies built in favor of the buyer, and we get 2 hours from closing and the buyer still pulls out? How does that look in the deal as it's presented from the buyer to the seller, if you're a seller, and vice versa? If you're a buyer, how do you want to present your initial offer? How do you want to start negotiations to get the seller interested in your offer, right? So all these considerations are put in play. And so I said I'd come back to the amount. And that's where I'm going at with all this included. The other thing that was brought to light here today by the sellers was, and it's a soft concern. I'm not saying it's a total hard concern, but it was a soft concern, not one I hear often. But obviously these guys are super experienced, and again, back to the multiple sales. The question was, we got a letter of credit saying they're good for this loan up to this loan amount, but we don't have anything saying that they got the cash saved up to cover the difference at closing. And that's legitimate. That's a legitimate question. And some assumptions get made here, all of which is part of the risk assessment by the seller and needs to be brought to the table by professionals such as myself. And the assumptions are this, is that the lender took the time to go ahead and look at their bank accounts to know that the available funds, sufficient amount of funds are available today that match what they're saying they can put down as a down payment at closing day. And so there's a black hole here. Could we have spun and said, hey, we want to take this, but we need a letter from your bank saying there's sufficient funds to cover the difference? The answer is yes. That can be a solution. Earnest money amount is going to be a solution too. You can pulling that earnest money lever. If you increase the earnest money amount due at the time that we go under contract, and the buyer willing to put that at risk, that could also solve that or kind of smooth out that black hole and not make it such a concern. So anyway, it was an enlightening conversation with these sellers, to say the least. They had really good questions. And buyers, what I'm saying here, buyers, when you're making your initial offer, you got to think a little bit of what the seller could be or might be thinking based on the way you present your offer. And sellers, you need to stop for a second and like these guys did, they had a lot of considerations they brought to the table. We had to walk through them one by one, figure out, prioritize, the list of risks. Say that 3 times fast, and then make a decision. I will say this much for this deal: the decision was to keep it simple, because I'm a huge fan of keeping it simple. The best deals that come together are the ones that are simplest. We pulled the earnest money lever. We didn't focus on any of the other things that we talked about here, and we rose that earnest money amount to an amount of money that the seller said, hey, if the buyer walks out on us, this is an acceptable threshold for us to say, okay, we'll let go of this contract and you can move on, and we'll move on. But this is, we're not willing to accept this little amount of money, but we're willing to accept this bigger amount of money. And all of which, in that deal, in this particular situation, we built in some barriers for the buyer, actually, so we could work through some contingencies within the deal fluently without earnest money being such a rub up front. Meaning, we're asking for it to be non-refundable like midway through the contract. We didn't ask for it to be non-refundable today, but after we get through inspections and title and some of these things that are going to be important to the buyer anyway, let's get to a point where we can let the air out of the balloon a little bit. We can all relax. We know it's going to be a good deal. Let's get worked through as many contingencies as possible. In this situation, we're on a 75-day close, so we just picked. Let's work through the first 20 days. Yep, the first 20 days aggressively, and then the remaining 45 or 50, we can sit on cruise control. And so anyway, we built in a barrier there, at which point, if we get worked through these contingencies, the buyer's comfortable with moving forward at that point, it's then that larger amount of earnest money will become non-refundable. So we'll see. It's to be determined if we get this deal or not, but we sent the counter offer back, and now it's in the buyer's field, and we'll see how it goes. But anyway, I felt like like this conversation with Stellar this morning with these sellers, and it really sheds a lot of light on earnest money itself in the concepts of there's more to negotiate than the purchase price. So hope this helps. If you got any comments or questions, drop them down below in the comments section. Love to hear some of your stories. Maybe you got some stories of the past that or experiences you've gone through that where this could have helped, or it did help. You were savvy enough and it did help. Maybe there was a trap that surfaced that you weren't aware of. So anyway, love to hear your engagement, and yeah, just go from there. And again, for any of those of you first-time home buyers, to anybody that's experienced in the buying and selling, I hope this video helps you and kind of gets your mind thinking a little bit outside the box, and give you a little better deal on your next real estate transaction. Talk to you later.